Hello, I'm Gerald Lyons. Liam Halligan is chairing this afternoon's session, but he's just been doing an interview at the BBC, so that overran. So he's coming along here as soon as he can. So if he runs in, panting, sweating, then we should be thankful that he's rushed here. If he walks in really calmly and casually, then we'll think, you didn't rush as quickly as you should. Anyway, so Liam will be here shortly. I'm going to therefore begin. First and foremost, today's 16th of October. So I'm going to begin by wishing you happy St. Gerard's Day. I am called Gerard. Not many people probably know it's St. Gerard's Day. If you're called Gerard, you might well do. So I might try and refer to some of his comments as well as we go along. But it's a good day, and I don't get the opportunity usually to say happy St. Gerard's Day, so I'm making the most of it. I'm talking about finance and investment, not about St. Gerard, and in the context of the index that's out today, what I thought I would do is focus my comments along the lines of all the P's. First, pillars, then policy, players, people, and place. Let me begin. I must congratulate the Lofoten Institute, probably the other speakers today have done likewise, for producing the Global Index of Economic Openness. In terms of this topic, finance and investment, the index has 5 pillars, hence the first P. The 5 pillars it's highlighted as being vitally important for the role of finance and investment in delivering economic openness are property rights, in particular, well-established, transparent and judicial independence and the reliable structure of property rights are key. The second pillar, not necessarily in order of importance, is credit and capital markets. And I'll come to that later because it's about the access to finance. Third is investor protection. Fourth is contract enforcement. And fifth is international investment. So the 5 pillars, property rights, capital markets and credit, investor protection, contract enforcement, and international investment. And really the key takeaway message in the 3 or 4 pages on this topic is that capital is key to development. The accumulation of capital is critical to successful capitalism and the financing of economic growth. So capital is key. Moreover, it talks about the importance of savings. Now, the reality of the situation is that there are various indices over the years, and most of them have different pillars. The question, therefore, is whether the right pillars have been chosen in this report. And I would say yes, and I'll come on to that in a second. But maybe if you were to think about adding another pillar, particularly in this day and age, it has to be along the lines of the 4th Industrial Revolution and the importance of data and technology. Particularly sitting here or standing here in London, technology is key and indeed critical to how the city and indeed to how finance is likely to evolve in the future. So the first key issue is the pillars chosen. Very sensible ones, maybe we could add to them as well. Second area is policy. Why policy? I think one needs, in terms of looking at finance and the relevance of finance, to look at all the key players. The policy environment set by the government and the regulators, then the intermediaries, which I'll come on to next, the players, and then the end user, people and the private sector. But in terms of policy, this is vital, and it comes out within this report. It's vital in terms of setting the right infrastructure and having the right institutions to set the right framework in which finance can operate. This is particularly relevant 10 years after the global financial crisis. The best way to think about the last decade, in my mind, is a pendulum. Prior to the global financial crisis, the pendulum was at one extreme, too light, self-regulation. Since then, as a result of the global financial crisis, the pendulum has swung to the other extreme, as is often the case, not just in finance, but in anything when something goes wrong. Now the question is whether that regulatory environment is too tough, too critical of the financial sector, and implicitly impacting and impeding what the financial sector can and indeed will do. Pendulums eventually, as we all know, settle in the middle. So I would argue, likewise, the pendulum has to swing back slightly. But in terms of keeping the pendulum in the right framework, right space, financial stability is key. And that's not figured too much in this report in terms of the Global Index of Economic Openness. Financial stability is critical to ensure that the financial system does not implode. And indeed, financial stability must continue to evolve. Cyber risk, operational risk, indeed many types of risk. But also, there are many aspects of policy that are sort of well established, particularly here in the UK, and I think will remain in place. And the report touches on these, particularly the legal system, naturally English law, very important here, and also making sure that there is enough trust, as has been touched on in the previous sessions, in how the system can and will operate. So the second P is policy. The third P is the players, the financial intermediaries. As well as the government, it's the actual players in the financial system who play a vitally important role. The report here gives a very positive view of the UK, and indeed in one place it talks about how fees are incredibly low. I would push back and say we need to differentiate between the wholesale, namely the wholesale capital markets, and the retail markets. And here in the UK, the city is well positioned in terms of the wholesale and indeed the capital markets generally. And indeed there, partly because competition is intense, the city has to perform well. Fee structures basically give you value for money. When it comes to the retail market though, wow, we have so much to learn. In fact, I'm with Net Wealth. Net Wealth Investments is an online discretionary wealth manager. In some respects, it's a fintech type company. I mention it not only to give it a plug, but also because we use technology, we've only been going 2 years, our fee structure is probably a third to a quarter of that in the industry. And the fact that the discretionary wealth management industry has been around for so long and that the fee structure is so fat shows that even here in the UK, there is still a long way to go. So before we call the UK as a success, as the report does in many areas, there is still a lot that needs to be done. But quite importantly is the need to provide for the players, the private sector, and that's the next P. One of the challenges in any financial system is to make sure that the players in the financial system do not lose sight of the need to provide capital, which is a key part of this report, to the end users. And one has to ask and question whether small, medium-sized enterprises, even here in an advanced economy like the UK, have that access to affordable and readily available capital in the way in which they should. Naturally, here we've seen the market evolve into many different areas in terms of venture capital, private equity. But if one looks at other economies, maybe at their stage of development, there is still a long way to go. But also data democracy. A key part of the fourth industrial revolution is data. We need to make sure that players, namely people, have access to data, or the data that they have about, or the data about themselves that's made available is basically governed in the right way. So access to finance and to make sure we safeguard the people and indeed the private sector. The final P I'm going to talk about is place. The report itself talks and focuses on different countries. The reality of the situation is that one size does not fit all when it comes to the financial sector. Therefore, one needs to question whether you can have a sort of global index of economic openness in terms of finance and investment that covers all the countries in the right way. Depending on your stage of development, your financial needs will be different. For instance, Vietnam or Philippines, the focus there would always be about corruption as being the most important issue. Not that they want it, but they actually need to keep it under wraps. Here in the UK is very much a different need. But when we look at place, it's also important to bear in mind the role of finance within the UK economy. We have a very imbalanced UK economy. The imbalance is always cited in terms of London versus the rest. But it's much more than that. It's urban versus rural, skilled versus unskilled, old versus young, property owners versus renters, and also finance versus industry. I'm always amazed that politicians seem clueless about how big the service sector is in the UK economy. And indeed, whenever a politician seems to want to plug the private sector, they always seem to have to go to a building site, have a yellow helmet. And indeed, in terms of our current Brexit debate, the auto sector, which, gosh, I'm not sure what percentage it accounts for the economy, but in terms of employment, it's less than 1%. That's central to our whole Brexit strategy. Whereas the financial sector, which is basically critical to the economy's future success and big, often comes low down the pecking order. But the good thing is for London, how things have evolved in the last 2 years, and many aspects of this report indirectly touch on the success of the UK in many different areas of finance and investment. Attractive to investment, partly because of the institutional structure and the transparency and accountability that is in place. 2 years ago in the city, worries after the referendum focused on passporting, euro clearing and people. Since then, worries about passporting have effectively gone. It does depend on your business model, but passporting is two-way. Clearing is less of an issue, although the government is in danger of causing this to be a problem by its lack of clarity and the need to ensure that the clearing houses that are based here are kept happy. People is probably the most important issue, given that 1 in people in the City of London is a European from outside the UK, a member of the EU. So attracting skilled people and having a sensible migration system is very important. But what's been most interesting over the last 2 years, and I cite this because it's key to the future debate, is how there's been a sea change in the attitude of many financial firms, largely because London has really established itself as the fintech capital of the world. Indeed, the tech companies, within months of the referendum, all announced that they were going ahead and proceeding with their large-scale investment in London because they saw London as the second centre of tech outside of Silicon Valley. When you combine that with the basically intrinsic skills of the city, you can see why fintech is well established here. But London continues to make itself not only a place to do business in, but to do business from. In the last 2 years, we've seen the growth of the RMB market, the Chinese currency, Islamic finance, green bonds, as well as a host of other areas. But the thing we should not lose sight of, and I'll finish on this, is the need for finance to service the domestic economy. Within the domestic debate in the last 2 years, or within the Brexit debate in the last 2 years, this has not really received enough attention. To make a success of Brexit, the UK needs to do 3 things. It needs to have a good relationship with the EU. That seems to be where all the attention has been focused. It needs to position itself globally, which is where much of the rest of the attention has been focused. But also it needs to get its domestic policy right. And we have not focused much, if at all, on that aspect. And finance plays a key role within that. And it will play a key role within that here in the UK. But a central feature of this report in terms of its focus on finance and investment is the role that finance plays domestically within any economy that one wishes to talk about. So putting it all together, congratulations to the Legatum for producing this report. And in particular, the relevance of the finance and investment section, I think, is key to future as well as current economic success. And to leave you with the P's, the pillars that are underpinning this aspect of the report are sound, but they probably could be expanded upon to take account of technology and data. Second, policy, the key player, the government. Third, the other players, the financial intermediaries. Then about making sure finance is accessible and available to people and the private sector. And finally, place does matter, and the UK and London come out well in this report, and I think should continue to do well in the future. Thank you.
As an introduction, I've been working in finance for over 25 years, first in investment banking with an emerging markets focus, and then in asset management. I studied Spanish for part of my degree, and so Latin America was an important early focus for me. After that, I've been an investor in global equity markets since 2002. And I've seen, as a result, up close, how culture and regulations differed between markets. My current job at Lofoten Asset Management is as a global equity investor. We run long-term mandates on behalf of our clients, My job is basically to pick the best stocks for our clients' portfolios on a 3 to 5 year view. And also, I'm in charge of ensuring that we comply with our commitments under the UN's Principles for Responsible Investment. I'll talk more about ESG later. Over the past few years, I've spent a great deal of time talking to companies and their senior management about how they think about entering into new markets. It's not always good. For example, I remember the conversation with the chairman of a very large UK supermarket firm about why they just entered Japan. The core of his answer was that it was a really big market and they needed to be there. As equity investors, we also have our kind of shopping list of things we need to see in place before we buy into a new company or a new market. So I thought I would talk about some of these. First of all, as Gerald and many of the other speakers have said, a culture of trust is absolutely critical for finance and investment to succeed anywhere. Equity investors also need to see a stable economy, governed by the rule of law, of course, and where regulations are sensible and predictable. Governance, which in its most basic form is the protection of minority shareholders' rights, that's what we do, is very important. Certain markets have taken great strides in this regard. For example, Brazil, which previously had a very bad reputation in that area, now has established a novo mercado and has left a lot of other countries behind. We also need to have confidence in accounting standards. Well, we've seen a few issues in that regard in our own country in the last couple of weeks. That's an important one for us. And growing in importance is ESG, what I just mentioned. I think some of the most important areas there are respect for employees' rights and also environmental standards along the supply chain. Not only are our end investors increasingly interested in this, but also those businesses' customers and other stakeholders. And this is an area where companies individually as well as governments can work together to raise the bar. In the early part of my career, I was participated as an advisor in the great wave of privatizations that rolled over Latin America in the 1990s. Some of these didn't go that well. For example, the Venezuelan government decided to sell its portfolio of stakes in hotel companies, which I duly visited as part of our mandate. That was quite a fun experience. However, the government also decided that in order to make those stakes sellable, it would terminate the contract with the operators who were then running the hotels. They were probably among the biggest hotel companies in the world. So the termination of their contracts didn't really go down that well. You can imagine the result. Then there was the Latin American country, another country, which decided to privatize its telecoms company. And that privatization was so unpopular with the unions and the public at large that us, the advisors, had to go into the headquarters building every day through the back door in order to avoid the pickets. That sale was eventually aborted after a referendum, even though we had actually quite a good slate of companies who were willing to buy the telecoms company concerned. So I thought that those two examples illustrated the importance of getting the basics right, really having someone in the finance ministry who understands what private companies need, how to get a deal done, and also how important it is to persuade the country at large that private investment is a good thing over the long term and will benefit them. On a more optimistic note, I have seen at first hand how links develop ever more closely between developed and emerging economies, and how there can be progress made in tackling inequalities through the power of trade. Welcome, Liam. A couple of years ago, I visited a company in the far west of India, a rural and very arid region on the border with Pakistan, which had been significantly affected by the Gujarat earthquake of 2001. Investment-friendly measures, as well as a lower national tariff barrier, encouraged a local industrial company to set up a series of textile plants, which have now made it the biggest exporter to the US and the UK of home textiles, and a supplier to many household name retailers. You probably have some of their towels and sheets in your own home. In a very challenged region, employment has been significantly increased while respecting human rights and the environment. And the company involved have also made some quite significant investments in local infrastructure, including schools, water and sanitation. Although India still has a lot of barriers to progress and inequality is still very significant there, I think the success of the textile sector in particular shows what progress can be made when the private sector is encouraged. Lastly, I wanted to touch on another aspect of my investment experience through my involvement with Oxfam's Enterprise Development Programme. This is a social impact fund which harnesses the power of business, not aid, to grow employment and develop opportunities in emerging markets. As we all know, and everyone said today, to make entrepreneurs successful, you have to have finance. And in many of the markets, well, in all of the markets where EDP operates, the banking sector is absolutely rudimentary. In order to have a bank loan, you need to give 100% collateral, which isn't a lot of help if you're a small entrepreneur. EDP gives bank guarantees, supports these companies with financing, and critically provides business training to allow those companies to grow, manage their cash flows, and create jobs. Now, our long-term aim, which we all dream of, is to stem migration from rural areas and improve the life chances of the people there, particularly women. While poverty continues to be a significant issue, there are entrepreneurs with ideas who deserve support. Thank you.
Thank you. All yours, Liam.
Yeah.
I've spoken, Rosie's spoken. I did prep people that you were rushing from the BBC.
Thank you very much. Sorry everybody for being late. Thank you to Lofoten, sorry to interrupt your presentation. Thank you to Lofoten for asking me here, and to James Sprawl in particular for organising this event. So I'm Liam Halligan, I'm the proud co-author with Jerry there of Clean Brexit. We wrote we wrote a version of that book, didn't we, over the Christmas of 2016, and it's come out in various guises. Part of what we talk about is the process of leaving the European Union, which of course has turned out to be far, far more complex due to particularly the parliamentary arithmetic, I'd say. A big chunk of our book though, about 2/3 of it, is about how the UK can trade with the rest of the world more outside of the European Union, and also things that the UK economy itself can do outside the EU that it can't do inside the EU. I'm thinking under that latter category of things like free ports, for instance. A lot of people in the northeast of this country who are very, very interested in setting up free ports or tax-free zones where goods can be imported and exported tariff-free. We can't do that when we're inside the customs union. We can't do that when we're inside the single market either. These are the kind of big economic issues that are lost, I think, in a lot of the media coverage that we have. We hear an awful lot, understandably, about the parliamentary shenanigans of whether or not we're going to be inside the customs union or outside the customs union. And yet we don't really think about the underlying economic reality of what those things mean. They just become vapid phrases thrown around by political correspondents who don't even know what customs union is. We just want to be in it because it sounds good. And that's really why Jerry and I wrote the book, because we are close to a lot of the political debate and the journalistic debate, and we wanted to bring some kind of factual economic analysis and just a basic defining of terms to the debate. Not that many people have thanked us for it, hey, Jerry?
Giesler did mention it in the previous session, particularly the forward.
Particularly the forward. So, I'd like to speak a little bit about the customs union, if you don't mind, because I do think a big part of the benefits from leaving the European Union come from being outside the customs union, and that has been lost in the current debate. I wonder the extent to which it's actually ever passed the Prime Minister's mind what being outside the customs union actually means and the benefits it can bring. I think throughout she has seen Brexit not as an opportunity but as a cross that she has to bear, which is completely the wrong way around to think about it in my view. And I know many people that voted Remain, I didn't, who would agree with that last sentence that I just said. So one thing is when you're inside the customs union, and people here at the Garden like Shankar have done a huge amount of work on this, but it's worth just highlighting it. When you're inside a customs union, particularly if you are a country that exports and trades more with the rest of the world outside the EU, as the UK is almost uniquely among all EU countries, certainly among the big EU countries. So the share of our exports going to the EU has fallen from 60% to about 40% since 1999, if you include the Rotterdam effect. If you are a country that trades more with the rest of the world than the EU, then the customs union's common tariff barrier, you have to pay that on the imports that we get from outside the EU. And a lot of those imports are of things like food, clothing and footwear that poorer households spend on disproportionately. And the money that's raised under the common external tariff in this country, and it's about £3 to £4 billion a year, it's quite chunky. 80% of that money, of course, goes directly to Brussels. So if we're outside the customs union, our households, our shoppers don't have to pay the common external tariff on those goods. They can get access to goods on global markets without the tariffs that are often there to protect inefficient, high-cost producers of the same goods elsewhere in the EU. So it's not even protecting UK industries. That's one point about being outside the customs union, a benefit that we won't get if we do end up staying in. The other point, of course, is cutting our own free trade agreements. Now, before I come on to that, I hear a lot, and I see it on Twitter all the time, about the 64 free trade agreements that the EU has cut with the rest of the world that we will be walking away from. And my head falls into my hands, really, because anybody with an open mind and 10 seconds and a browser can find out that of those trade deals that the EU has cut, many of them are with very, very small countries, and even principalities, and less than 30 of them are actually ratified and operational. The cardinal point here is that the EU, despite 60 years of trying, has not cut a free trade agreement with the US, our biggest single country trading partner, or with China, of course, or with Brazil, or any of Mercosur, or with India. During these Brexit negotiations, it signed a political agreement with Japan. It's a very long way from a free trade agreement. Let's see how long it actually takes. Cheers. Do I need that? No, I don't. To actually get that free trade agreement. Of course, it's good news if they can. But the cardinal point here, ladies and gentlemen, is that as long as you are a substantial economy, it's actually easier to cut free trade deals as a single country, because you don't have the often conflicting aims and obligations that countries have within the European Union. If you're trying to cut trade deals, 27 countries, each with conflicting obligations, or with many conflicting obligations, that makes it very, very difficult. Often but not always, the obstacle is agriculture, with the French and les Pays-Bas fighting hard to preserve agriculture. That's often a deal breaker, but there are other deal breakers too. So the trade deals that the EU has cut, and they're much less in number than you commonly read about, the actual ratified ones, generally cover small countries, and the ratified ones are currently less than 10% of the global economy. Yes, less than 10% of the global economy. And the trade deals that are cut are generally favouring French and German interests rather than UK services anyway. So I think we can do much better cutting our own free trade agreements outside the customs union. If Switzerland can cut a free trade agreement with China after a couple of years of negotiation as the, at the time, 21st biggest economy in the world, then I think we have a reasonable chance as the 5th or 6th biggest economy in the world. So we can open this up to discussion. My point I want to make today here is that as the media swirls around the parliamentary complexity of the situation that the Prime Minister finds herself in, we have to remember the actual economic issues that are at play here. I think the UK will be better off outside customs union for the reasons I've said. I think supply chains are an issue, but you have just-in-time production happening happily between Canada and the States, where there's no customs union. We import all kinds of just-in-time products for supply chains from outside the European Union anyway, and if after Brexit, if we're outside the customs union, it's up to us and our government how difficult or easy we make it to import components from the European Union. We can have zero tariff if we want, and often on components there is zero tariff, and tariffs are charged in the finished product. These are all very simple concepts, but they seem to be far too complex for mainstream political discussion. And I'm often amazed at, when I talk to senior politicians about how little they actually understand about the underlying economic issues. And that's why I think it's very important that organisations like Lofoten exist, and congratulations to you on the work you've been doing and the extent to which you've had to bang your head against the wall throughout this complex negotiation. I'm still hopeful that in the end, Downing Street will realise that the best way forward is a free trade agreement, Canada Plus. I'm hopeful that in the end, and I spent a lot of time in the Republic of Ireland, Dublin will realise that they can actually help to bring about a solution to the Irish border issue. It can be solved with technology. Cameras already exist. They already exist. And actually that issue... It's interesting, ladies and gentlemen, the Irish border issue, Gerald and I wrote about it in our book.
We've both probably crossed the Irish border many
times. My family actually comes from Mayo, which isn't a million miles from the Irish border, and I've many relatives in Northern Ireland, so I crossed it a lot as a kid when it was militarised and ghastly, and since. So I do understand the sensitivities. But I was on a show on Irish television, RTE, on Friday called The Late Late Show, which there's nothing like it in England really. In the UK, it's got like 70% audience share. So I was literally in a green room with Graham Norton and Mrs. Brown, you know, Brendan O'Carroll and Bob Geldof and Barry McGuigan and the Cause. And Alistair Campbell glowering at me in the corner. And anyway, so I went onto this sort of chat show talking about the Irish border, and guess what? I was clapped. I didn't get shouted down, so maybe, and I thought... I thought...
Did Alistair Campbell get shouted down? Did Alistair Campbell get shouted down?
No, he got cheered to the rafters, of course. I was going to use the Piers Morgan line. When's there going to be people vote on the Iraq War, Alistair? But anyway, I didn't. I thought that would be below the belt. But I sense across the Irish political firmament, this is my last point, Jerry, I sense, and even in the Irish press, which is astonishingly black and white on this issue, there's almost no debate in the Irish press. Brexit is completely terrible and it's all the UK's fault, and there is no way to solve the Irish border issue. I sense you are starting to get realisation now, if only from the business lobby, that the UK is trying to solve the problem. I believe that, and that if there isn't a deal, the country that suffers most of all the third parties is Ireland, given that 4/5 of Ireland's goods exports use the UK as a land bridge. So I'm obviously, like a lot of people in this room, pretty concerned about where the Brexit negotiation is, but I am hopeful that in the end common sense will prevail and we will end up with a free trade agreement between the UK and the European Union, with a solution to the Irish border that's based on existing technology and goodwill, which is completely possible, and that in the end, hopefully, Europe more broadly can return to what it should be, which is a nation of independent nation states trading and cooperating freely and with goodwill. And sorry again, I was late.
This is a question for Liam and Gerald. In terms of free trade agreement, Canada was mentioned in the last panel by Ali from the IOD. That took 7 years. So the likelihood of a Canada, Super Canada, or whatever it's called at this point, what do you rate that? What do you rate the probability of? I know you want one, but how likely is it in a timely fashion?
The difference is, and this line is often thrown back in the face of people who advocated Brexit, we're starting off perfectly aligned. We're starting off perfectly aligned. By definition, we are perfectly aligned. And so the debate, the discussion would really be about I feel, I'm here at the Garton, the citadel of expertise on this area. So forgive me if I oversimplify or sound as if I'm oversimplifying. What really matters is the divergence mechanism and how you deal with divergence going forward. And given the extent of our institutional relationship with the EU, that should be solvable. These institutions already exist. We can set up proxy ones, proxies to the ECJ or some hybrid of a Supreme Court and the ECJ. So I think all those things can be solved. Gerald and I, and obviously Gerald can talk for himself, we've always felt from the very first writings we did on this and the first discussions we had on this in the days after the Brexit referendum, we always felt there would be political madness and headbanging, and it would go to the wire, and you would need a transition agreement, a transition period after the political exit in order to sort out the free trade agreement. That's why we became some of the first people, I think, to advocate a transition period. And when we did, a lot of other people who supported Brexit said, no, that's mad, that's mad. You do need a transition period to bed down a free trade agreement. I don't think it's nearly as difficult as Canada, because Canada was actually an agreement between 28 countries and even some principalities in Walloon. So this is an agreement between one country and a legal construct that it knows well from perfect alignment. Now, in that sense, David Davis is right. This should be the easiest free trade agreement in the history of the world, but the word should is doing a hell of a lot of work when you've got politicians trying to destroy it. On an Irish theme, it was Brendan Behan, the incredible Irish writer, who said, there's never a situation so dismal that politicians can't make it worse. And you do feel, with the best will in the world, that there's an awful lot of people on one side of the channel who are determined to make this difficult, pour encourager les autres, and then across the Irish Sea who are trying to make it difficult because since Enda Kenny left, I mean, it was fine when Enda Kenny was there, right? And it was fine when May had a majority, right? Between June 2016 and 2017, no one talked about the Irish border because it was fine, because it's not an issue. It's only become an issue since Kenny's changed and Varadkar's a minority government. He needs some support among the Shinners, who's going to kick the Brits in the knees. And then, I know about these things as an Anglo-Irish person. And then since Theresa May's obviously lost their parliamentary majority and been taken in by a group of advisors who basically don't want to leave the EU. And that's why the word should is playing such a heavy role in that sentence. But Davis was right with his original statement. It should be pretty easy.
Well, I agree with Liam. Actually, coming back to your question, Richard, allows me to use a quote from St. Gerard, actually. As I mentioned, one of his many quotes, for those who came in late, I mentioned today's St. Gerard's feast day. Hence, consider the shortness of time and the length of eternity. This is particularly relevant for the Chequers agreement.
Did he say that as well? Did he foresee it?
I should have used the quotation marks before I got into Chequers.
Tone of voice.
But Chequers actually ties our hand for the future. That's the biggest challenge with it, which is why I would endorse Liam's points about Canada. But bringing it back to finance and investment, in terms of the EU, what I think has become evident over the last few years is two aspects. One, the importance of finance within your own domestic economy, which, as I touched on, is an important part of the report's focus on the financial sector. And I think it's an aspect of the UK debate that we need to address a lot more, the domestic agenda, and we talk about that in the book. But what's interesting is when one looks at finance, and particularly financial centres, is how global the competition is. And I was very struck, as Liam was before the referendum, how many people were keen to predict doom and gloom and the end of almost all civilization in the City of London. But we had the same situation before the euro came into effect. Then we were told that if London or the UK didn't join the euro, we would lose out. And in particular, and it's hard to imagine this now, at that time it was said that London would lose out as Europe's major financial centre to Paris, you can imagine that, Frankfurt, or Amsterdam. Amsterdam in the latest ZGN survey is 32nd global financial centre, but it was 50th at Christmas, but it moves between 32 and 50. It's hard to picture London and Amsterdam together, and it shows how things have moved on. And the real challenge is global competition. Ahead of the global financial crisis, Hank Paulson, then the US Treasury Secretary, was advocating deregulation and reform of the US financial system. That was all put on hold for the last decade, shall we say. Now it's back on the agenda. And London needs to be very mindful of the competition from New York and also from the likes of Hong Kong, Singapore, and eventually Shanghai, particularly with sort of 24/7 global finance in the future. So we need to be mindful of the global agenda and the need to work with the Financial Stability Board to ensure the right set of global rules are in place. But within that, there needs to be sort of competition, and competition becomes key.